Thank you very much, everybody, for attending. Michael, happy birthday, and thank you very much for the opportunity to present this evening.
Thank you.
The first, we'll begin with the disclosure to appease our lawyers. Everything mentioned here is for educational and informational purposes only, and there's nothing that's a buy or sell recommendation. All charts are courtesy of freestockcharts.com and/or stockcharts.com. That being said, let's take a look and roll up our sleeves and get started. Q4 market outlook. Our thesis has been that QE, or quantitative easing from the Fed and other central banks around the world, has been the primary driver of this 4.5-year bull market. The S&P 500 from the March low is up over 160%. It's one of the strongest bull markets we've seen in history. This year alone, it's up before today's sell-off was up about 23%, 24%, which is the strongest year-to-date gain since 2003, so in the past decade. So clearly we're in a very, very strong Fed-induced bull market. Now, when the music will end, how will it end, will it be ugly or not, that's beyond the point. What we know right now is what's actually happening, and our job as a market practitioner is to interpret what we see happening in real time and then, of course, change when the facts change. In the short term, as we've been saying for weeks now, the market's very extended and due for a pullback. In the intermediate long term, we're still bullish as long as the market remains healthy, and our job now, especially after today's move, is to ascertain the pullback and see whether or not it's another ordinary healthy pullback or something more severe. So there's a lot of back and forth and a lot of debate whether or not QE affects the market, and this is a clear picture. It's the S&P 500. You follow my mouse. Back here on the left-hand side, this is a monthly chart, so each one of these bars is a monthly chart going back to the end of '06. All the way up until this month, until today. What happened is in 2007 you had the high at 1576. We'll revisit that a little bit later. But here's the entire financial crisis, or the sell-off. I don't know if you can see my mouse or not, but basically the S&P fell 58%, all the way down to the March low. QE1 was announced, and that basically it was a credit crunch. What happened was the Fed and other central banks had to inject a tremendous amount of liquidity to unfreeze the credit markets, because that's really the backbone of the financial system. And that's really more or less what QE is and other easy money from the Fed. What that means in layman's terms is that you're injecting liquidity, which means that you flood the system with the ability for banks and other big players in the economy to buy and sell and just have money move easier throughout the system. Well, QE1 hit right around the first quarter of '09, and the S&P, A, it stopped the decline, stopped hemorrhaging, and then B, it rallied 45%, which is a tremendous move in just over a year, right around a year or so. What happened was QE1 ended, and then within a blink of an eye, 2.5 months, the S&P dropped 17%. And then QE2, of course, we all remember Bernanke's famous speech, Jackson Hole, back in the summer of 2010, I believe. And then that led to the September 1st follow-through day or rally was confirmed, and then the S&P jumped 36%. And what happened in a very short amount of time, this was a nice orderly pullback, the end of 2010, early into 2011, and then QE2 ended. Of course, what happened? The S&P drops 22%. And again, these are all facts. I'm not making any of this up. And then, of course, the Fed, to help prevent a further decline, they want to reflate asset prices in addition to flooding the system with liquidity. And the primary asset price they want to reflate the U.S. equity market. What happened was you had basically Operation Twist come in, which is a fancy way of saying more flooding of the system with liquidity. The S&P jumps 37%, or almost 40%. So as you can see, after QE1, 45% rally in the S&P, 36%, and then 37%. Well, all of a sudden, the QE2 is about to end, and more or less it's over. Operation Twist comes in, but Twist wasn't as powerful as people wanted. The S&P, right around last year, actually, right around last November, the low was November 16th, fell. Sorry, let me backtrack a second. This 11% pullback happened. It was a 10.9% pullback, and then QE3 was announced. Market rallied again, and then it started falling, and this is the November 16th low from last year, which is the Fed had announced 40 billion, and that wasn't enough, so they doubled up and basically said, okay, we're going to buy 85 billion a month, which comes out to 4 billion a day, which is just a crazy amount of money as far as flooding the system with liquidity. And then from this point, which is last November, to today, the S&P is up about 31%. So that's a very, very strong if you want the evidence or the proof, the facts don't lie, that clearly show that the primary catalyst here for the market is QE. Why am I spending so much time on QE? Is because of the fact that it's so important to understanding what actually is moving the market. Today you had GDP come out. GDP was slightly stronger than expected. Any data that suggests that the Fed may taper, i.e. stronger than expected economic data, in the short term is going to hurt stocks. And that's exactly what we've been seeing for the past few months. Tomorrow, of course, we have the jobs report. A lot will tell then. But as of right now, from my standpoint, the most important thing is just to focus on QE. And weaker than expected economic data is going to help the market because that means QE is going to continue for a while longer, and stronger than expected economic data in the short term is going to hurt the market because it might threaten QE or help the Fed begin to taper. So our long-term outlook, we're bullish. Why? We believe in April of 2013, a new supercycle began, or a new multi-decade bull market. And if you look back and study history, let's take a look at this. You see several areas in the market, in the S&P or Dow, which we'll go through in a few slides here, that are big congestion areas. So you have 16 or 17-year periods, 20-year periods where the market goes nowhere and then blasts off. What happened in April of this year was that 2007 high that we spoke about in a previous slide was taken out. So this was a 2000 high, this was a 2007 high, and then April of this year, the S&P just tore right through it. And what happened was, this is a 13-year, more or less, congestion period or sideways period in the market, and it was resistance. That 1550 was the old high, more or less, in 2000, and then 1576 in 2007. So what we want to see now is that level become support. That's the longer-term picture from our time frame. And of course, this is an upward trend line. This is an annual chart, by the way. Each one of these bars is a year for the S&P, and it clearly shows the clear upward trend line for the past 4.5 years, almost 5 years now. So multi-decade consolidations, what are they and what happens after? The good news is every multi-decade consolidation so far in history has been followed by a tremendous new bull market or a super cycle, however you want to word it. But since the late 1800s or the early 1900s, we've seen several times in the market where you've moved sideways for a decade, and sometimes more than a decade, 15 years, 20 years, in some cases even longer, before exploding higher. Few examples we'll go through. In 1906 and 1916, you had 10 years. After the roaring 20s, you had the Depression, and really that was one of the longest sideways periods. The market moved sideways for 25 years. In 66 to 83, 17 years, and then 2013 to 2013, you had a 13-year sideways consolidation. What happens now, it's yet to be determined, but after every other one of these prior consolidations, they were followed by huge bull markets. So in the simplest terms, it's either we continue moving higher, and this is the beginning of a new super cycle / multi-year bull market, or we roll over, negate that 1576 breakout, and then spend more time moving sideways. So let's take a look at some of these sideways periods followed by large gains. Here are the roaring 20s. This is the chart of the Dow. Again, this is an annual chart, so each one of these bars is a year. And as you can see, just explosive rally going all the way up until the 1929 crash. You had a big, big reversal. And of course, it was a crash on a daily, weekly, and monthly time frame, but this is the annual bar. So you had a big, big sell-off, and then followed by a 4-year nasty, nasty depression / crash in the market, and it was just one of the worst peak to trough just moves ever. It took 25 years for the market to digest that, and then if you notice, this big annual bar in 54 was a breakout above that 1929 crash high. So a sideways consolidation, and then what happened thereafter, here's that bar, a huge bull market. So, you know, am I here to predict anything? No. All I know is what I'm showing you the facts, and then we can move forward and we can interpret what we see happening. So you had a 25-year sideways period, and then boom, a new bull market was born. 1960, then the market moved sideways after that bull market for 17 years to digest that move. Again, this is all healthy action. And what happened right here in the early 80s, you had a big breakout from that consolidation, and then it took off. It spawned this whole entire 1980 to 2000 bull market. Now, you were up almost every single year during that time frame, except for the 87, I believe, was that one down year. But more or less, you had a tremendous, monster rally. And of course, this was fueled by several things in the economy and in politics, and you could talk about interest rates, and you could talk about the internet, the dot-com bubble, and every other one of these major rallies was fueled by a lot of innovation, for lack of a better word. But where we are right now is just interpreting what we see happening. Lots of times the what drove that rally comes after the fact. What I like to focus on is the when. What's actually happening? When do we get in? When do we get out? And that's how we can monetize it and actually make money navigating this market. So after this huge 1980 to 2000 bull market, you basically move sideways. And here's a 13-year consolidation. You had the dot-com bubble, March 2000 high, that 1550 level we spoke about earlier, and the dot-com crash, or the bear market crash. Of course, you had 9/11 right in there. And then after a nasty 3-year crash, the market bottomed in October of 2002, and then it started to rally. March of 3, you had a real powerful just follow-through day / beginning of a new confirmed rally, and then it just took off. Then from 2000, more or less from 02 to 07, you were up every year. And then you had the housing bubble, which drove that. You had the credit bubble, which drove that. You had a tremendous amount of commodity bubble. Oil prices surged at that time, and several other commodities as well. And it's just easy money was sloshing around the world, and that all led, of course, to the 2008 financial crisis or meltdown. Another nasty bear market in the S&P, and the Dow and the Nasdaq as well all followed in the market. So you had two nasty bear markets in this 13-year consolidation. Of course, the market bottomed. We said QE 1, 2, and 3 in this time frame to help the market rally, and then you break out of that 13-year consolidation. So what we see now is just very, very healthy action when you step back and look at a longer-term time frame. The intermediate-term outlook we feel is bullish as well. This chart, sorry if it's a little fuzzy, but went out in one of our reports, and this is just basically a daily chart of the S&P 500 going back to the fourth quarter of last year. And as you can see, every single one of these pullbacks is shallow in both size and scope. By size, we mean percent decline, and scope, we mean a matter of weeks, not months. This was that November 16th low that we spoke about last year, which more or less was that when the Fed doubled up. QE3 wasn't working at $40 billion a month, so the Fed was like, okay, let's just double up, and they did that. Now it's $85 billion a month, and all of a sudden the market takes off. And of course, the fiscal cliff, you had a little bit of a sell-off there, but that was a blip on the radar in hindsight, and then the market just took off. So every pullback this year has been under, for more or less has been shallow. It's been under 10%, and that's healthy. So in a bull market, if you recognize the fact that we're in a strong bull market, a lot of people have a difficult time making money because they're usually used to buying breakouts. And the problem with buying breakouts, it goes back to the old Wall Street adage of, you buy the dips and sell the rips, is that you're buying that rip, which means that the market's ripping higher, and then inevitably you're getting in at the worst price, because what happens is you get in somewhere around one of these tops, and then the market pulls back, shakes you out, and then takes off again. The other thing that we can notice here is that most of these pullbacks not only been shallow in size and scope, but also have a series of lower highs and lower lows, by definition forming an uptrend. The market is going from the lower left to the upper right. And the blue line in this chart is a 50-day moving average. The red line is a 200-day moving average. So again, right now we could be beginning a more significant pullback. A lot of very ugly action in growth land today and other areas of the market as well. We'll get into that in the next section. But as long as it's a short-term or shallow pullback, we're going to be very optimistic if that we're able to see a short-term bottom, if it's another short-term pullback in size and scope. But of course, no one knows just yet. Let's take a look here, more of the intermediate term. So this is a weekly chart from the March 2009 bottom. Just again, we like to review things and just take a step back and see what it's actually happening. The white line here is the 50-day moving average, or the 10-week moving average, really, on a weekly chart that roughly corresponds to the same thing. And then the red line is a 200-day moving average or a 40-week moving average. So take a look here. Each one of these bars is a week. There's that March 09 low that we spoke about. And you can just see it. It didn't hug the 50. It did not even, it broke the 200 at times. The 50-day broke below the 200, which is called a death cross, and then here's a golden cross. And more or less since then, the 50-day moving average is moving up. The market has not held the 50-day perfectly. It did here for a while, but then pulled back. So the 50-day moving average, even though it's a very, very strong indicator of strength, for the S&P, it hasn't really contained the pullback as well as 150-day or the 200-day for the most part. Now, you've broken below the 200-day a few times during this rally, but it's a really strong look of the intermediate term. Are we moving up or down? That's what I want to show you here. And clearly the answer is we're going from the lower left to the upper right, so that's clearly a strong uptrend. Here's a weekly chart from the Dow, and basically illustrating the same thing. Clear uptrend, moving from the lower left to the upper right. These charts were taken, by the way, earlier this week, so they do not reflect today's action. This is a NASDAQ, again, weekly chart, more or less the same thing. Here's a small cap Russell 2000 index, and this is the standout winner. Since the March 09 bottom, this index is up, not including today's action, 220%. Based on earlier this week. So if you look at all the other indices, the S&P I believe is up 160% somewhere in that area, and the Russell 2000 is hands down the strongest index. This year, the Russell index is, I believe, up over 30%. Again, being one of the strongest indices. The reason why I focus on that is because typically, when we allocate capital or invest in markets, we want to look by the strongest areas, and clearly this space is definitely a strong space that's been outperforming, and tends to outperform in early parts of cycles. Now, the short-term outlook. Clearly, the market's very extended. We've been saying this for weeks. It's not rocket science, but let's just take a look here. Here's the S&P 500. Here's a daily chart, and every time the market gets a little over 4.5% above its 50-day moving average, what happens? The market pulls right back. This is not a formula or any type of trading system per se. All it is something that I've noticed over time that's been very helpful to me to know, okay, we're a little bit extended here. And it's not a surprise. Just recently, the high in the market was 1775 in the cash. Just let's see, what was it? About 2 weeks ago. Not even the 30th. So the end of October. And the 50-day moving average at the time was 1694. So right again, if you just look real quickly, let's pull up a quick calculator here, and you have 1775, 1694 on the 30th was the 50-day moving average. Then you divide it by the 1775, and you're looking at 4.5% above the 50, right there. So again, it's just something that I use as a little tool of the trade, if you will. But every one of these pullbacks, if you go back and run your own studies, you could look at all these arrows. More or less, the market was up over 4% above its 50. The 50-day moving average almost acts like a magnet where it pulls it right back down. And the same as the opposite is true also. Not here because these have been shallow pullbacks, but in more deeper pullbacks. It's a good way to gauge whether or not you're extended or not. Plus, you can just look at the number of stocks in the S&P 500 that are trading above their 50-day moving averages or below their 50-day moving averages. When you're up over 80-90% of stocks in the S&P that are above their 50, typically that, in conjunction with this little index or indicator that I use, clearly shows that we're more or less due for a pullback.
To go along with everything that you just said, Adam, we had a question come in about the diverging volume and what your take on the diverging volume is.
Diverging on a daily chart or a weekly, or are we up or down? There's a few ways to answer that question. What we've seen, I mean,
on the weeklies,
we haven't
just
on the weeklies. Okay, so what we've seen is, let's pull up a real-time chart. Well, we can use this one actually. You have the red bars are down weeks, the green bars are up weeks, more or less. And besides this big spike, which might be an error, you have more or less more green than red. That's the first takeaway. As far as distribution weeks, as the classic way they're defined in the paper, you have a volume that's heavier than the prior week. I mean, that's more or less the way it's defined. So you don't see a lot of those. You see them, but not a lot. So what it tells me is that we've been rallying on light volume. That's more or less average volume. So you haven't seen a lot of green spikes. You've seen a few here, a few here, a few here, a few here, but you don't see a lot of above average or heavy volume buy days. But that's not necessarily a bad thing because there's just not a lot of sellers. Granted, there's not a lot of buyers, but there's just not a lot of sellers either. So if you start, what happened today, which, let me throw in a real-time chart here. Let me see if you guys can see that. Pardon these little ads here on the right-hand side. But right here, look at that volume spike. And that's just a daily chart. And here's a weekly. So you're starting to get some heavy volume here. So if you start seeing some heavy volume on the downside, that's something to be careful about. But more or less, volume is secondary to answer the question in a broader sense. Price is primary as far as I'm concerned. Does that answer the question?
I think so. And I think that most of us would agree with that too.
Okay, perfect. So let's take a look here. we have the Russell 2000. This is a chart actually of today's close. I was able to throw it in there right before the presentation began. And notice a few things here. Number one, you broke down below this high. So you negated the breakout. And that low more or less corresponded with that high. So you broke out, you had a nice rally, pulled back. It did find, let me annotate the chart, it's probably easier that way, support near its prior chart highs. But today, it negated the breakout. And then, let me get the trend line. So here was a breakout, more or less. Right there, it tested it, held it, it broke out that day. And then today, negated the breakout. And the 50-day moving average is that white line right there. So if it holds a 50, you know, we'll see what happens. But clearly, you're at an important inflection point. For the S&P 500, since we're looking at the short term there, here are the old chart highs right near that I'm watching at least that I want to pay attention to. This was the high from the Fed when the Fed did not taper in September. The market pulled back hard. It was also the government shutdown and all that noise. And then all of a sudden you bottomed right near 1646 and then just took off. You broke out above that high right there on the 17th. And then you more or less hovered up in this area, and then now you got that nasty, ugly, down negative reversal, and it's also an outside reversal day, which means that the bar today was bigger than the bar yesterday, and it's going to pull back. It's going to either test and find support and then bounce, or it's going to break down and then retest the 50-day moving average. So from my standpoint with the S&P, this was resistance. You want to see it become support, and then the next level is the 50-day moving average. Let's get rid of that guy, bring back into the Russell. In a bull market, one of the most helpful things you can focus on, which we briefly touched upon earlier, is to buy weakness, not just strength. Obviously, everyone loves buying for the most part, people love buying breakouts. The problem with that is that you're doing that whole thing in reverse. And I know a lot of people, that are in this whole growth universe, and they're having a very difficult year and a very difficult time because they're just struggling to make any progress. They're buying stocks at the pivot point or a little bit above or a little bit near it or breaking on trend lines, and whatever the case is, they're buying strength, not weakness. And this year you've been rewarded and rewarded handedly if you just step up and buy weakness. And it's very, very difficult to do that. However, if you're able to find the right stocks, leading stocks, for example, the reason why we created the site findleadingstocks.com, the whole idea is to help people find leading stocks. So if you're able to focus on those leaders, every week we give out a leaders list as well, and the 20 strongest stocks year-to-date performance-wise in the S&P, for you to always know where the strongest stocks are by definition, not just our own list that we watch, but also just the strongest year-to-date performers. If you could start shifting your focus a little bit, I'm not telling you to become bottom fishers here or change your strategy or change anything way that you're looking at markets or viewing things, but one of the things that helped me a lot, especially when I broke out of the whole rule-based, using someone else's rules opposed to using my own. The reason why I created my own investment formula was because I realized that I'm using this guy's rules and other people's rules and it's just not working. So I said, all right, I've got to just stop, restart, and reverse engineer it and just focus on what actually works. So if you look at this chart and you bought those pullbacks, you would have done exceptionally well. So it's very helpful. Another little trick of the trade is to focus on buying weakness, not just strength. It's okay to step up if you know you've got conviction, you've got everything, all your checklist, whether you're a fundamental guy or a technical guy there, but you can step up and buy weakness. It's not a bad strategy.